Welcome, everybody. Thank you so much for attending today. I appreciate everybody who came and who's going to watch it on a recording. I wanted to walk through Fibonacci and go through how we use it on a daily basis for our trading and why it matters with our setups and answer any questions that that everybody might have. I learned Fibonacci probably about a decade ago. My original mentor, who retired a few years back, used it very heavily. And one of my very first classes that I took, it was a Fibonacci class that he gave, and it really opened up the door for me. It opened up my eyes to see certain things that I just did not really know before. And now I heavily rely on it. So I wanted to get into it and show you guys some of the things with it, especially with the TradingView, with the setups and how to set up your tool, and show a couple of charts and take a couple of questions if you guys have them. So I'm going to share my screen. And I'm going to move you guys off to the side over here. Okay. So in TradingView, you will find Fibonacci on the left-hand side, third icon from the top is your Fibonacci stuff. I don't use most of the things in here, but so these are the ones that I use, is the Fib retracement, the Fib channel, and the Fib time zone. And I can tell you that the last two, the Fib channel and the Fib time zone, I almost never use those. Every once in a while, I'll look at them just to get an idea of something, and I'll go through those just for 5 seconds later because they're not the main ones. The Fib retracement is the one. That's the one that everybody really looks at, and the one that seems to work the best for everything. At least in my opinion, in what I've seen over the years. So with the Fib retracement, when you choose that, if you look at a daily chart, any daily chart, and you have the levels from the high and from the low, it doesn't have to be all-time high. It doesn't have to be all-time low. It just has to make sense to where you currently are in the chart. You wouldn't want to pull a Fibonacci level from the bottom here to the top over here if you're trading above it already. So most of the time, what I like to do is, if you have a chart that is a little choppy and a little hard to tell where you want to put the levels, even if you're trading on a daily chart, I tend to move outwards. And I move out to either the weekly or the monthly. So depending on where you are, like, you can see the levels much clearer of where those longer term bigger pivots are. So you can pull your Fib, like there's a bunch of different levels that are in this area here. So where do you pull it from? So I would go to a monthly to pull my top. So you start at the top when you click, and you move your way to the bottom if the chart is on the way up. So when you think of it this way, if your stock is going up in price, you want to pull from the top to the bottom, so that way your numbers are getting bigger from the bottom up. So you'll see that it'll start getting closer to your 1 from 0 as it's moving its way up. It would just be the opposite if the stock is going down. You would pull from the bottom to the top, so that way the numbers are going on the way down. So for you to set this tool up, once you pull your first Fib, if you double click on one of your dots, you can put in here all of your levels. These are the normal Fib levels, are the ones that have the checks on there. Me personally, I change my colors so that all of the fib levels are black except for the 618, which is yellow, and that's my golden number. So the golden ratio from Fibonacci is the 618. So I made it gold. For the most part, the ones that are most tradable are your 382, 50%, 618. Those are the three. Your 786 and your 236 are less so, because by the time it gets to 786, it's kind of extended. And when it gets to the 236 is kind of when you're looking at the fib. Because in general, when you are going to put a fib level, you're not going to know where to put that level until it bounces from somewhere, because you don't know whether it's the low or whether it's the high until it starts to move away. So by the time you know that that's the right place, you're going to be so close to the 236 that you're not going to use that level for really much. But if you can see, I pulled that on the monthly, and look at the zone, the 50% zone. At your 50% fib, you have a level that it hit already. It's at the 200, and you have all of these lines here, all of these lows and highs in that general area. So it's a zone to watch, and you can see that it respects that zone in the past. Even if you look back at the 618, the 618, it's bounced off of here, and it is a number that looks like it's respected even back in time from that level. If you're pulling it on the monthly, you can still go backwards and look at the lower time frame. Just because you're pulling your fib at a higher time frame doesn't mean you have to trade it on that higher time frame either. So if you go back, we're on the monthly, if you go back to the weekly, you can see where your zones are. Like, you would not notice this 382 level, how good it really is on this particular chart if you were looking at that monthly. That 382, it's okay in here. It's right in the middle of all of that chop, it looks like. But when you go down to your weekly chart, that's the number. It's hitting it. It's hitting it on the way up. It's hitting it on the way back down over here. It respects that, and that's also where you have your moving averages also converging there. This is your, I believe this is your, on your weekly, that's your 40-week MA. So your 40-week MA is sitting right at that fib number that it respects. So now it's heading up and it's going through your 618, but it's right at that number. And look at what happened in the past on that 618. It bounced off of it, came back up. It bounced off of it, came back up. Even when it bounced and it went through it, it stopped right at your 50% and right back up to the moving averages and 618 before it dumped back down. So these are levels that have been respected in the past as well. You can go down lower time frames, and sometimes they may or may not make sense to what you're looking at. On this one, you can see it bounce right through that 50% before it comes back down. And that's on any chart. These are just ones that I picked out on here, but they work on pretty much everything. If it doesn't, that level may not be a tradable level, or it's not, at least on a Fibonacci level. So if you're looking at other charts, it doesn't matter which ones you choose. You can start pulling fibs from any place that is a high to a low. So what I like to do is, if I pick, like here, silver, just one that's in play lately. So on a daily chart, you can see where those levels are. So I'm going to pull a fib from here. So from the top to the low. And on here, when we're looking at it, there's really not much that I would trade off of this. So, it's very choppy in between. So in some places, it may not make sense, but you can go back in time further to see if other things make sense. So from here, you can go from where the move starts to where the move ends. And where did it hit? 618. It hits the 618 and bounces up from there. So if you knew that once this started dumping out all the way and you said, okay, I'm going to pull a fib from where the move started to where the move ended and see where it's going to go. If you were to buy the 618 and trade your way up, that's a 22% move on silver. And for me, with things like that, if I don't have a zone where I know that I want to get out of it, you can sell at the other fib levels. You take a quarter off on the 50%. You take a quarter off on the next percent. Every way you go up, you can do it that way and sell off a piece of it on the way back. This is on the way back down. It hits it, it goes back up. So you can do it that way and take off a quarter, take off a quarter, take off a quarter. And then the last quarter is your moon bag. And you let that run as far as you can, move your stop to under break even, and you don't have a loss on any part of your trade. You can also go the opposite way. And as it bounces, you can take off this fib and you can pull a new fib from the top to the bottom and say, okay, I'm going to take a piece off from here, starting at the numbers that make sense, which is usually 382, 50%, 618. Everything else is golden after that. So if you took off a piece here, piece here, piece here, and you move your stop to break even or just under if you wanted to do it that way, you'll be in the money on that trade by taking 3 different pieces off of it, and you're scaling out the way that Morpheus teaches us to scale in and scale out of positions when it makes sense. And you can do that on any time frame. This happens to be a weekly time frame, but it doesn't matter. You can do it on the daily time frame if you want. You're just finding where those levels make sense in the long run when you're looking at where they line up. So you can do that on absolutely any chart, even with crypto. So with crypto, you can go into here. Let's say, let me make this a little smaller. So if you did something like the low to the high, and look and see where your lines are, like this 618. Look at where it was. It hit here, broke through, it hit it, came back up, hit it again. It ripped up, but on the way back down, it hits it, bounces around here, off the 200 and back up. And then where did it stop again? Right back at that 618 again. So it's almost like a magnet for certain equities. Some of them respect them real well, and some of them may not. You'll go on charts and you'll pull fibs left and right. You'll spend an hour pulling fibs on a chart, and nothing may line up. But other ones respect them more often than not. And if you look at things like volume on where you're getting in, like there's the fixed range volume profile. So if you pull one from where it took off to where it ended, this is where your volume is. So it's right in that general area from here. Oh, sorry, I should have pulled it further. Still in the same spot. It's right in that general vicinity of where that 50% is. So more people got in around that level than any place else on the chart. So you can pull it from anywhere. I just chose this spot because it made sense to me, but going back a little further, it looks exactly the same, but look where all the candles are. So with Fibonacci, it's just a matter of finding where you want to pull the fib from. So sometimes you'll pull it from different areas just to make it make sense. So if you pull it from here to here, This general vicinity is where it came down to. A lot of times it's not going to be exact science of where it goes to. Oops, sorry. That was the wrong spot. There you go. But it bounces from the general area. Some of them may not work. Like this one, I don't know that this one is the best. I wouldn't have traded any of these on this particular one. But if you look at it on the weekly, it might be different. So if we look at it from here, I would pull from the bottom to where the top came in. And where did it bounce from? Exactly from a 382, which had in previous history, it was a pivot that was hit and came back down, came back right back down to the 50% before it took off on the way up. But on the way down, it respected it. It hit it on the way back down. So these are the spots where you can pull them from. So depending on what your time frame is, and depending on what chart you're looking at, you may want to go on a longer time frame. The biggest problem that you have is when the charts are at their highs. When they're at the highs, there's no fib level for you to actually pull back to yet. You know, so on this one, it's starting to pull back a little bit, ASML. So if it was me, you can go from the bottom of that move to the top here and see, does it make sense, any of these fib levels, that it could pull back to there? And to me, the one that jumps out at me is the 50, because it's right at those pivot highs. It's right where this one stopped over here, all of these here, and you have your moving average directly on that 50. So to me, that makes sense as a spot to watch. And even the 618, I would still watch that 618 because that's where this candle hit before it took off and the move kept going. There were sellers in this area who came in and the buyers picked it back up. So is it a place I would watch? Sure. Is it one I would trade? Probably not. I would be more inclined to trade this 50% one because I have confluences there. More confluences than just one candle. Does anybody have any questions so far? All good?
All good.
All right. So on a chart like this, one of the other things is your extensions. So if you don't have, if you're in new high territory, even if it's just new recent high territory, you can do fib extensions. So if you are going to go fib extensions, you would increase these by adding a 1 in front. You could actually go higher than that and do 2, 3, 4 in the front here. If you see the ones that I have listed here, you can go up, and I'll show you mine. So in mine, I have one that I named expansion fib, and these are the ones that I use. Let me get that. Sorry, let me do this so it shows opposite. And from here, these are the opposite expansions. So from that level, if we put, let me put a 1 on there just so we can see where that is. This is where your 1 is, this is where your 0 is, and it goes from here. So if it goes up, it'll go up 236, 382. These are the expansion levels as if it was inside of here. And that's what you would look at. If you had another chart, let me find, like if you did like Bitcoin is not at an all-time high right now. So if we had, sorry, this way. From here, Oh, sorry, I should have done that on a smaller time frame. So if we pulled from here and you wanted to see where this was capable of going, this is your extension zone. So your 236, 382. Let me get rid of that one. But look where your 618 is. It's right at your pivots, or fairly close to them. Even your 50%, that's your 1.5, is right at a bunch of pivots. You have a bunch of pivots in here, bunch of pivots in here, this whole consolidation zone. So these zones are areas to watch. And at that time, when it gets up that high, is when you look and see, does it make sense? Does it have moving averages in that area? Is it overextended by the time it gets there? Is it starting to consolidate? Is it showing you patterns in that general area? I wouldn't trade specifically off the Fibonacci extensions usually, but you use those as price targets more than anything. That's how I use them, is price targets. So for me, when it hits the area of confluence up here of all of these pivots and all of these consolidation zones, I'd be thinking about taking some pieces off of it from there. And it's the same with one like this that's at an all-time high. If it was me when I was doing this one, I would think that from here, once this consolidates, these are the zones that I would think about possibly getting a piece out. Like 50%. Look where that 50% is. It's almost directly in line with this pivot. If you go out on a monthly, see where the rest of them are. It's in the chop here, not one that I would trade. That 618. It's a little too far off from there, but that 50%, that would be where I took most of my money off. I'd let the rest run. So you can do it in the opposite direction as well. Anybody else have any questions with it? Rodolfo, you have your hand raised?
Yes. Hi, John. Thank you. So before the call, I was playing around with the Fibonacci retracement with the ETF SPY. And now that you're going through it.
What is it? SDY?
SPY.
Oh, SPY. Got it.
But now that you're going through it, I think it kind of maybe I do have a question, which is does it make more sense to use Fibonacci for individual stocks versus something that moves more like an index? Because an index is a consequence of everything else moving inside it, right?
Well, yes and no, because it's not only the individual stocks that are being purchased that move the ETF, because people are buying that ETF as well, which will in turn purchase the underlying stocks that are in there. So when you buy the ETF, like if you go and you buy $1 million on one of those ETFs, that ETF is technically supposed to own those shares of the stock that it has in the index. So it works the opposite way as well. But there's no reason why you can't have a retrace on something like an ETF. So it's always worth looking at. Let me get out of that.
I was
So
actually looking at the short term, the last couple of weeks.
yeah.
I cannot see anything that
Oh, there might not be in the last couple of weeks, but take a look at this one. This
Yeah.
was just, off the cuff just from looking at it. You pull it from here to here, and look where it stopped, like almost to the dollar on the 50% retrace before it took off again. So
Yeah.
it does work for sure on there, but it's not going to work on everything. So it depends on where it is. Like right now, it's not going to work anywhere because where you are on this chart, you're not going to have a retrace anywhere in the vicinity of that. So like if the SPY starts to dump back down, what you do is you would pull it from the move. So from the bottom to the top, and you would say what makes sense. Like look at this 50% line. That 50% is in an area where there's some chop over here. It's something to be aware of. I wouldn't trade that one necessarily from that level because it doesn't have other confluences there. But even look at where the 618 is. The 618 is directly at the gap. It's at that gap. As soon as this gapped, that's where that 618 really is. So if you have on the way back down, if this starts making it back down to the 618 and your moving averages start to follow it down into that area, that's an area to watch. It might not be an area to just buy right away just because there's a 618 there or just because there's a gap there. But if it has a 618, it has the gap, it has moving averages there, it's one that you might want to look at with a tight stop on there. But you can still find stuff like that ahead of time. It doesn't have to be on the spot that you're going to buy it from that fib. It should actually be here. So it's actually at the gap window, which is right here. So this is where the gap started, not where the gap ended. I just had it in the wrong spot there. So it still is at a gap. Not only is it at a gap, but it's also at this pivot right here. This pivot here before it started on its way up. So you're still at a spot which makes sense over the long term. And this is on a weekly. So, there could be other things on a daily. Like if you look at where this is, look at where this chop is. All of that consolidation is right in that 618. It's right here. And then it gapped from there.
Okay. And would you say then, based on what you're saying, it sounds like it's more like it's not that Fibonacci gives you necessarily resistance and support, but it gets you paying attention to specific resistance and support that happened before.
Correct.
That might be more relevant than others.
Correct. And it's yes, but it's also you have a lot of people, a ton of people who look at Fibonacci. So it's one of those things that, you have a bunch of people that trade off of these Fibonacci levels. It's like a self-fulfilling prophecy, because if they're trading at those levels, it causes pivots and things like that. So if you have a lot of consolidation, a lot of pivots in one area, and it happens to be a Fibonacci area, you not only have your pivot buyers at that point, you have your fib buyers at that point as well. So it's almost like a double confluence with that. But if you are just pulling fibs and there's no levels anywhere else, there's no pivots, there's no moving averages, you don't get all of that. The biggest bang for your buck is when you have a confluence of things like that, where you have pivots, you have moving averages, and you have a fib, because you have different buyers all at that same level that are there for different reasons. So you have 3 different sets of buyers that are going to be in that area. You don't care why they're there, but they're there. So if you take a trade at that level, it doesn't matter why that other person took it, they took it. So you look for the confluence more than anything else. Does that make sense?
Thank you. Yeah. Thank you.
No problem. Anybody else have any questions?
Hey, John, it's Darren.
Darren, yeah.
Hey, just one thing I've noticed here. Great workshop, by the way. Really, really great. But one thing I noticed talking about the Confluence, I think that is really the key. I found that the more levels from multiple time frames that align, the more reliable, more powerful that level is. So, for example, the weekly and daily and the 4 hour, if they all align at a certain level, and one's 0.50, one's 0.382, that's really powerful. So I just wanted to point that out there. I think that the most reliable ones tend to be where there's multiple confluence and multiple time frames. That's just my take on it.
Yeah, so that brings up the next part, actually. So thank you for the segue into that. So the way that I will tend to do a lot of these is I start on the higher time frame and I move my way backwards, and not just moving backwards by pulling the fib in one and then looking at a shorter time frame. What I will tend to do is I will pull a fib on a higher time frame. Like let's just choose Bitcoin. I didn't look at this one in the past, but we'll do it together right now. So let's pull a fib from what makes the most sense to me right now is this. Just looking at it, that's what makes sense to me. And this confluence zone looks like it makes the most sense. That's 618. It's coming right into the moving average. You have all the chop here and everything else. Moving back down to the daily level, you can still see the fib on the chart. But let's take a look and see, when we look on the daily, does anything else make sense to us? So let's try from this pivot to this pivot. It's a little hard to get it in there. Nothing really lines up that well from here. But that's how I would wind up doing it. I would look for different confluence zones from here. So if it's trying to get that level there. So if you do from the low here to the high, you would see, does anything line up with the other Fibonacci? On this one, it happens to not. So I would take that one off and I would move on to that. But you can do that on different time frames for different equities. So on this one, let's see. This one is, if we pull, let's go into a bigger time frame. And let's say we're going to take high to the low before the move. And then if we go to our daily, and see what lines up. So over here, you have a couple of things that line up. The one that makes the most sense to me is this one right here. So this one right here has two different levels that line up from two different times. And if you look at where it's pivoting, it's hitting the pivot here. It's right above it over here. It's all of this chop in here. And also this 382 is very, very close. You're not going to always get them exact. Like this one is pretty close. It's got to be in the same zone. So in this zone, you have this pivots here, these pivots here. You have this one, this one, this one. All of these are in that zone. All of this consolidation is in that zone. Then it drops back down, comes right back through. Now, where is it? It's at your 618 over here, which is a good zone in general, but these are the confluence zones that I would originally have looked at. So you can do that. Even this one here, this 786 level, it has a double confluence of different time frame Fibonacci's. And if you look at what happened in the past at that, You hit it, you hit it, you hit it on the way up. You hit it on the way down here, on the way down, on the way down. You hit it a ton of times, all the way back. You're going all the way back to 2016 at this point, and you had to hit this thing a dozen times. So to me, that zone makes a whole lot of sense. If it gets back up to there, I would think it's going to bounce off of that before it ever goes through it. I don't think that it's going to blast through that. So that might be one. If I was going to, short something, I might short that with a tight stop above it. Or if I already own it, that would probably be where I took my profit, or at least a big part of my partial profit. So you can do that on any time frames that you want. It doesn't have to be daily, weekly, monthly. You can go down to the 30-minute chart and still have a confluence in there. So, or an hourly chart. Let's do an hourly chart because it gives you, more bars in there. Yeah, see, this one's not a good one to pull for hourly because it doesn't go back far enough on the hourly for this one. But in general, you can do that. If you have a zone that, let's see, it's a 4-hour chart. So you could do it on a 4-hour chart. So from here, we'll pull to here and see what other confluences we have. And if you get too many on the screen and you need to get rid of them, from here, you can turn off some of the old ones and keep just the ones you want. And the good thing about these is when you put them on, if you know that you're going to be putting more than one, you can name them if you click on them twice. So you know which one is the weekly, which one is the monthly, which one is the 4-hour. So you know which ones you're turning off at the time. Because it gets a little confusing having all of these lines on the screen. But even having all of these lines on the screen, you can see where your zones are. Look at that zone that we were looking at before. This zone up on the top here, it has a lot of stuff on it. It's got a lot of confluence on there, and here too. You have a bunch of different spots that line up on different time frames, and that's just an area to watch. It's not one that I would immediately say go and buy this, but look at it from history. In history, some of these zones mattered.
Hey, John, I have a question. What is the significance, if any, of any confluence between Fibonacci levels and daily averages, exponential or regular moving averages, or just resistance and support levels?
Well, you have different people that are buying for different reasons on there. So you have people that are moving average people, and they tend to buy around those moving averages. And you have Fibonacci people who tend to buy, those levels as well. But the Fibonacci people, most of the time, what they're looking for is the pivot levels from that, because it's all based around the pivots for Fibonacci especially. So you tend to have, when you have people that are buying Fibonacci, they tend to base those around those pivots. So the ones that really line up, you have different strategies that are trying to buy at the same level. So it makes it work more often than not, just because you have so many different types of buyers in that area that are looking to buy or looking to sell at a certain area. It's the same with the moving average people. The moving average people, if they see that your moving average is in confluence with a pivot, even if they're not using Fibonacci, if it's in confluence with a pivot that sold off before, they're going to sell off again. They're going to get rid of. They're going to get out of whatever it is, and if it breaks through that, maybe they buy it at that point. But they're confluence zones more than anything. One doesn't work because of the other. they work more because of the people that are sitting at those levels waiting for it to hit, if that makes sense.
Yeah, in other words, they tend to be independent of one another in the minds of those who use them.
Yeah, because a lot of these people, they're not looking at multiple strategies at the same time. What the best trades come from the trades that have all the different strategies all looking at one spot. Those are the ones that tend to work better than others. You know, even people that do trend lines. If you line up a trend line and like, not that this trend line will, you know, make a lot of sense, but if you take a trend line from here and you do it here. If this level over here was at a fib level, you would have the trend line people, you would have the fib level people, you would have a bunch of different people looking at it for the same reason. This one doesn't work that way, but you know, that's the way that I look at it, is I try and align as many strategies, even if it's not one that I use or would trade off of. If it's one that I'm aware of, I like to see where those people are looking to get in and out of their stuff. Whether it's a stock, whether it's a crypto, you know, it doesn't really matter. I'm looking for the areas that these people are looking to do what they're going to do, whether they're going to buy, whether they're going to sell. I don't care about their strategy. I just care where they're getting in and out. So
right.
I'll put a bunch of trend lines. I don't tend to trade a lot off of trend lines, but I'm aware of them. You'll see them on my chart fairly often. And 99% of the time, I'm not really using those trend lines for much. I might use the trend lines that are more flat trend lines that are pivots and things like that. But the ones that are like this, these upsloping trend lines and stuff, you never know where they're supposed to be. You know, it'll go through it and then you'll move it, and it'll go through it and then you'll move it, and you're constantly moving and maneuvering these things. The ones that are flat ones, like here, I would say something like this would be a better one to watch. So I don't use these, but I will put them on there because other people use them. So I want to see, does one of those line up with my Fibonacci and with my moving averages and other things? If they all line up, it's just one extra piece of Confluence for me. It just gives me that extra little percentage of, you know, in the right direction of taking the trade. I won't not take it, though, if a trend line doesn't line up or anything like that, because they're not my favorite. But I do put them on because if they do line up, it's just an extra little Confluence for me.
Okay.
Anybody have any other questions or any charts to look at or anything they want to go over?
Oh, I got a chart if you want to look at.
Yeah, might as well. I mean, listen, it may not line up on there. You know, it might not be anything that we could use, but we'll give it a shot. Yeah.
I don't trade futures, but the spot gold price has been doing just some very weird things lately. It's been very volatile on just enormous volume. And that is
this one?
XAUUSD.
Gotcha. This one here, the capital.com one?
Yes. Yep. That's fine. And if you look at the volume, and is that the daily? Well, that's the daily. Look at the volume of the last few days.
Yeah.
It's unbelievable. And if you did a fib on that from the high to the low around whenever it was, January, February, and you look at that and look at how that works with fib and where it is now. And
sitting right at it with the moving average.
Yes.
These work. And even when it hit the bottom here and was on its way up, Look where it hit before it came back down. It hit the 50%, came back
Yes.
down, bounced off the 236, back up. It was within pennies of the 618 before it came back down. It respects the fibs pretty well.
Yeah. And I'm going to bet that most gold traders probably use fibs to, do their, as a strategy.
I would tend to agree with you on that. And like, if it came down to the 382, the 382 has a moving average. It has pivots here. It has, chop in here. That's one that, if it came down to there, I would take a trade like that and put my stop, down a little bit over here or something similar to that, depending on where I got in. But you can do things like that if you know that you have a tight stop. If you're going to start putting your stops all the way down here, that I would probably stay away from that. It depends on where if you have a spot that makes sense that you can get out, that is not just a random, I need to get out and, be, I don't know, 3%, 5%, whatever it is. It still has to be out at something that makes sense.
Yeah, I mean, right now it's kind of bouncing off the 20, which is, just under the 50, or is it just under the 618?
That's under, and there's an 8.
Right under the
8 EMA is directly lined up with the 618. Like I have to roll over it to get the color to change.
Yeah.
So it's right on it. And this is the 20 MA is what is riding along the bottom. The 50's down here.
Right.
So this worked great on this one. This worked
interesting
great
to watch.
It's definitely one to watch for sure. And just out of curiosity, I don't know that that would work, but if we pulled it from the low of the move up to here, does anything line up? This one right here, look at where it went through. It went through the 618 and then ripped from the 618.
Yep.
And the 618 is a confluence zone with this chop right here. It bounced off of it here, and it was at this pivot right here.
Yeah.
So that's another zone. If it came back down to there, I would be a buyer with a stop below the low of this candle. So that kind of stuff makes a lot of sense to me, doing it that way, and I can see why other buyers are there. So it just gives me that extra level of confidence to get in on something like that. I learned through Morpheus not to overdo my trading size just because I feel like something is going to be great, and because that's the first. Every time I do that is when the bottom drops out of it. So I keep cool with it and keep my strategies in place that I learned here, and I'll take trades like that.